Like anything in life, there isn't really a secret formula or a secret trick that doesn't require an investment of time from your end in order to learn something or to become good at something. This book focuses on fundamental analysis of companies. While the title of the book makes it seem like there are some easy steps and shortcuts, this really isn't the case. With that in mind, the 5 rules for successful stock investing, as the book recommends, can be summarized as such. 1. Do your homework. 2. Find companies with a strong competitive advantage or economic moat. Have a margin of safety. 4. Hold for the long term. 5. Know when to sell. So let's break these down and understand what they really mean. So the first one, doing your homework. This means that we must understand the business model and how the company operates, the products, and its revenue streams. While this does sound obvious, it is much less practiced than it really should. So you need to start reading up on the company, read the annual reports, see what the CEO and the company has to say. If the 10Ks and the annual reports don't really contain any useful information and it's mostly consultant speak, this is a huge red flag, and it should be quite easy for you to understand what the company does. Otherwise, it's not really worth investing. Second one, finding companies with a strong economic moat. A strong economic moat allows a small number of companies to keep a above average level of profitability over many years. And these are often the best long-term investments. The key to finding these moats can be found by answering the deceptively easy question: how does a company manage to keep competitors at bay and earn consistently high profits? While the question might be quite easy, the answer often isn't. In addition to this, it's also worth noting that historical high profits don't always correspond to future high profits. This is how capital and capitalism is supposed to work. Capital is drawn to areas of the highest expected return, which means that competitors usually chip away at profits over time. In any case, evaluating the moat can be broken down into 4 steps. First one is we must evaluate the profitability. Second, we must understand how the economic moat is built. Third is the competitive advantage period. And the fourth, we need to do an industry analysis. The first step in evaluating the profitability is finding the free cash flow. Cash is, as they say, king. The free cash flow is basically what the company has left over once all the operating expenses has been paid. The free cash flow can be found by taking the cash flow from operation minus the capital expenditure. We also want to compare this to sales and to see if this is consistently above 5%. Next, we want to look at the net margins. How much profit does the company generate per dollar of sale? This can be done by finding the net income as a percentage of sales. The net margins should consistently be above 15%. The next step is finding the return on equity. The ROE measures the profits per dollar of the capital the shareholders have invested in the company. It can be found by taking the net income divided by the shareholders' equity. The return on equity should also consistently be above 15%. The next step is looking at the return on assets. How efficient is the firm at translating assets into profits? This can be found by taking the net income divided by the total assets. The ROA should be consistently above 6 to 7%. It's a bit more difficult to have an absolute number here, and it's quite dependent on the industry. After we've evaluated the profitability, we can start looking at how the economic moat is built. It should usually be done from a customer perspective. What value does it bring to them? In general, there are 5 ways to build an economic moat. It can either be done by creating a real product differentiation through superior tech or features, by creating a perceived product differentiation through a brand or reputation, through lower costs for a similar product or service, by locking in customers
using high switching costs or making it uncomfortable for customers to switch. And the last is creating a high barrier of entry or success. We must then look at the competitive advantage period. How wide is the moat? Basically, how long does it last? And how deep is the moat? How much profit can it make? And in general, we must look at the industry. This can be done by looking at averages in the industry, but it is preferable to look at a few companies by sorting by sales or market cap. Not all industries are the same. It's easier to make money in some industries than others. What you should look for are the sales in general shrinking or increasing? What's the trend? Is the industry cyclical or is it stable? Is the industry dominated by a few larger players or several smaller players of roughly the same size? And how profitable is the average firm? So after we've evaluated the economic moat of the company, we need to evaluate the company. We need to put valuations on certain things, and we need to make sure that we have a margin of safety when we actually purchase the company. So in order to simplify and structure the process, it's suggested that we do this in 5 areas. The first one is growth. We want to be able to answer how quickly the company has been growing. It's also worth noting here that the same with profits, that strong growth doesn't always mean continued growth. Capital is drawn to places with the greatest return. Second one is, what are the sources of growth? There are usually 4 sources a company can grow. You can either sell more goods or services, you can raise prices, you can sell new goods or services, or you can buy another company. When looking at growth, we need to know that not all growth is the same. For example, buying another company is often not the best way to increase the growth of a company. You must also understand how sustainable the growth is for the future. You should look at sales growth rather than the earnings growth. Earnings growth can be due to cost cutting or other accounting trickery, but while sales growth is more difficult to fake or to change. Once we've evaluated the growth, we must look at the profitability. How much profit is the company generating relative to the amount of money invested in the business? The first step in evaluating the profitability is finding the return on assets. The return of assets is a measure of efficiency. Use this to compare against competitors, because not all industries are the same. Return on assets can be found by taking the net margin and multiply it with the asset turnover. The net margins in turn can be found by taking the net income and dividing it by the sales. The asset turnover can be found by taking the sales and dividing it by the assets. The next part in evaluating the profitability is looking at the return on equity. This is a measure of efficiency on shareholder equity. The return on equity can be found by taking the financial leverage and multiplying it with the return on assets. The financial leverage in turn can be found by taking the assets and dividing it by the shareholder's equity. Return on equity above 10% without any excessive leverage is worth investigating. Anything above 30% is probably too good to be true. So the next step, looking at the free cash flow. Is the company a net producer of cash or is it a net user? This is sometimes called the owner earnings. Above 5% free cash flow to sales is a good ratio and the company is doing a good job. This is very industry specific though. The free cash flow can be found by taking the cash flow from operations and removing the capital spending. Plotting the free cash flow against the return on equity is a good way to see how mature and risky the company is. This is referred to as the profitability matrix. The further up to the right you are in the graph, the more mature and less risky the business. Further down to the left, the more risky the company and less mature it is. These are companies that might one day become very, very profitable, but they are very high risk. The next step is looking at the overall financial health, the basic economic foundation of the company. In general, when a company increases its debt, it increases the fixed costs as a percentage of the total costs. The first one to look at is the financial leverage. Values above 4 to 5 start getting quite risky, but this is very industry dependent. We've calculated it before, but it's the assets divided by the shareholders' equity. The next is the debt to equity. This measures the amount of long-term debt per dollar of equity. It's calculated by taking the long-term debt and dividing it by the shareholders' equity. The next one is the times interest earned. This looks at how many times the company could have paid the interest on its debt. The higher here, the better. It's calculated by taking the EBIT divided by the interest expense. Next one is the current ratio. How much cash the company can raise if it had to pay off all its liabilities all at once. This is done by looking at the current assets and dividing it by the current liabilities. There is also an even smaller ratio, which is referred to as the quick ratio. This is the same as the current ratio, but it excludes inventories. This is good for manufacturing and retailers. So take the current assets minus the inventory and divide it by the current liabilities. And now we need to look at the bear case. This should be your reference point and the signs of trouble that you should look out for. Constructing bear cases is especially important for those who like to buy high-quality companies that have hit temporary problems. Because what might look like a temporary problem might very well be a roadblock or something much more serious on closer inspection. In the bear case, you should try to answer what could go wrong with your investment thesis. Be very critical of this. Why might someone prefer to be a seller of the stock rather than a buyer? The last part of the company valuation is the management. Your goal is to look for management that think like shareholders. The first thing is to look for the compensation. You should look how much the management is paying itself. Compare against competitors. This can be found in the proxy statement. You should look at bonuses. If the company gets big bonuses, how the salaries of the management is, the stock grants, option packages. You should also look at the pay versus the performance of the company. Next part is the character. Does the management use positions to enrich friends and family? Is the board of directors stacked with family members or former managers? Is the management not really forward about mistakes that have happened? Is the management very focused on the stock price and not on the company? Does the officer turnover rate scare you? Is it high? And the last part is operations. So we've already looked at the performance of the company, but it's worth to see if a change in officers or CEO has led to better or worse figures. Does the management follow through and implement a plan and keep on implementing new strategic initiatives? Does the management actually provide enough information for you to analyze the company? Does it keep quiet about certain parts of the business? How is the self-confidence of the company? Is the company doing something different than its peers? Is the company keeping a high research and development in bad times as well as good times?
So these are the 5 elements to analyze if we want to understand how well or how badly a business is doing, and if we think the business is attractive. Growth, profitability, financial health and debt, the bear case scenario, and the management. However, after doing all this, we still don't know if a company is a buy or not. We need to look at how the market has priced the company to understand that. After all, a great company bought at an expensive price can still be a bad investment, so let's now dig into the steps on how to see if a company is expensive or not. So the first step in understanding the price the market has put on a company is using several ratios. These are standard in the investment community. When using ratios, we must be very careful to only compare against same industries and very similar companies, because a ratio in itself doesn't tell us much, and a ratio in one industry might be very different to a ratio in another one. The first ratio to look at is the price to sale. This looks at the amount of sales per share. The ratio shows how much investors are willing to pay per dollar of sales for a stock. It's usually cleaner than the price per earnings because you can use accounting tricks in earnings, while it's much more difficult to hide this with sales. An additional thing is if earnings are negative, then you cannot really compare the PE, so then sales is much better to look at as well. Additionally, it's also worth to think of the profitability of a company. If the profits of a company is high, then the sales would be worth quite a lot. However, if the profitability of the company is low, then the sales is not worth as much. The second ratio is the price to book. This measures the market cap against the shareholders' equity. It's good to use to see if a company is over or undervalued. Above 1 is usually overvalued, and below is usually under. As always, it needs to be compared within the industry to get an idea of how it looks. As mentioned previously, price per earnings. It shows the stock price as compared to the earnings of the company. Similar to price per sales, but it looks at earnings instead. This is a very popular ratio. And really, it should only be used if we're comparing against something else. Just dropping a price per earning and saying that it's high or low doesn't mean anything. PEG ratio, price to earnings to growth. Similar to the price per earnings, but with growth added in. As we've mentioned before, not all growth is equal, and some growth is associated with higher risks than others. This is also very useful if we want to compare high growth companies or industries. Cash return. Well, this is not often used, but the goal of the cash return is to measure how efficiently the business is using its capital, both the equity and the debt, to generate free cash flow. The next step is doing a discounted cash flow analysis. This is used to estimate the intrinsic value of the stock. While I won't show you how to do one in this video, because I believe it's gone on too long already, it's based on the idea that the value of a stock is equal to the present value of its future cash flows. No more and no less. I recommend looking around on YouTube on a few videos on this. There are a few good ones out there. So armed with this, we can now see the intrinsic value of the company and compare that against the share price. And when we decide to purchase a stock or a company, we must always make sure that there's a margin of safety. The idea of the margin of safety is best seen in this image. While this is also simplified, saying that the intrinsic value of the company always goes up. This isn't always the case, but this is what we should base most of our decisions on purchasing on. And if we notice that this intrinsic value is starting to decline, that's when we need to start thinking about selling. Another reason can also be that we believe that the share price is way too high as compared to the intrinsic value of the company. So all of this analysis is very time consuming, as you might understand, but it's also very useful in understanding how a business operates and how you invest. The book also suggests you to go to Morningstar's website. Here there are a few shortcuts, so you don't really need to go through all of the steps to look through all companies in existence. It answers the following questions though. Does a firm pass the minimum quality hurdle? Has the company ever made an operating profit? Does the company generate consistent cash flow from operations? Are the ROE consistently above 10% with reasonable leverage? Is the earnings growth consistent or erratic? How clean is the balance sheet? Does the firm generate a free cash flow? How much other is there? Has the numbers of share outstanding increased over the past few years? In addition to the generalized guide on how to analyze companies, the book also gives a specialized guide on how to analyze several industries. These industries include healthcare, consumer services, business services, banks, asset management and insurance, software, hardware, media, telecom, consumer goods, industrial materials, energy and utilities. These guides are about 10 to 20 pages, and it gives you a rough idea on what to look for specifically in these industries. While this is useful, I believe some of the things might be slightly dated, but it's a great introduction on how to evaluate and valuate these companies yourself. In the meantime, though, there's plenty to digest, and I recommend buying the book yourself and reading it, and keeping it close to you. And then when you've done that, rereading it, and going back to several parts that you struggled with. So thank you for listening, and I hope you learned something today.